Let me give a brief introduction about it. This was created years back when we created this web page. The purpose for creating Investbiz was to you know to give a platform where newcomers and newbie traders in the market can learn and gain from our experience in the market. Together we have many years of experience. I personally myself have more than 10 years of experience in stock market, and I have traded across the segments from stocks to indexes to futures to options and even equity. And if you visit our page, Investbiz page on Facebook, you will see our growth journey, how we started with creating systems for our users where they can get useful insight and data, and how we have created so many strategies and backtested them. Also, we created automated systems back then. This is, for example, this one is this is a system which is using multiple lots. It's like 3 lot short and 2 lot short, 1 lot short. So it's like buy and sell signals with proper lots, how many lots you should be selling and buying. Then we traded options, and the reason for switching to options was because options trades, specifically on the sell side, if you are doing sell side option trades with proper hedge, it requires very minimum adjustments. And being a part-time trader, and in fact all of us are part-time traders, so we really don't want to give too much time to the market. And even if you are full-time trader, I think you should balance a strike between your personal life and stock markets, because stock markets can be really stressful if you give too much stress on making huge profits. And it can be really tricky, specifically for newcomers, when they, without any knowledge, start taking trades and then make some losses, and then they're under pressure of recovering that money. And add to it, there are so many YouTube channels and so many so-called experts who have been claiming huge returns year by year. So it's really stressful, and this is very lucrative as well. People are tempted, and definitely, as you all are aware, 95% of the people, or let's say 90% of the people at least, lose money. So yes, you have to be very careful. Without knowledge, nothing can be achieved. And not only knowledge, you have to practice a lot. You have to know the right things, do a lot of paper trading, and then you should get into any kind of active trading with real money. Now the question is how you should go about, whether it is options trading or it is regular risk reward ratio based futures trading. So I'll throw some insight on that as well, apart from our growth story, how we have grown, and the tools that we have developed over these years, from basic version of Optionstar to implied volatility scanner to advanced Optionstar. Then how we have really evolved ourselves as a trader, as investor, and finally settling as a dollar trader. So now we only trade USD INR and nothing else, because we are very comfortably making handsome returns with USD INR. So we are really not worried about even equity trading. Earlier we used to invest in equities, like this is just one example I'll give you. For example, in 2017, this was our personal private group. You see, we had given Philips Carbon around 153, and then it went to 637, and as you will be aware, it even went 10 times. Uh, this had been up to 1 year holding, and further it went up to 1500 plus. I think it went even 1600. Similarly, Jubilant Food, and we had given Edelweiss and Tanla. Tanla, for example, we gave at around 30 rupees, and Tanla is one stock that we have been recommending since long, and it has become 30 times. It went to 900 just a few days back. So, despite so much success in equity market, we just chose option selling with hedge because of the certainty. Equity has its own challenges, it has its own stress, and I think, to be very honest, uh, it was more of trading futures and options It is more of an excitement for us. We wanted to do something challenging, and we just thought that we should do that only rather than going for equity portfolio. But nevertheless, having made some good money, I think we will again return back to equity investing now. So these things keep on happening, But all the same, the basic concept is same. You should not be giving too much time, and you should not be taking too much stress. First, learn, okay, practice well, and then start slowly with little amount, and then gradually you increase your trading capital. As you must be aware, these are the initial trades that I used to put, and these were the initial profits, very little profits that we used to share. In fact, I remember when the first Zerodha challenges initially we used to win, it used to be for 30,000. So in 30,000 Zerodha challenge, we won 30,000, then 68,000, we moved out on 68,000. And finally, now we are at a stage where we're making 10 lakhs plus, 13 lakhs plus, and so on in every Zerodha challenge. So we have already won Zerodha challenge 10 times, and currently we'll be winning for the 11th time as well. Okay, so okay, this is these are all advanced Optionstar where we have 3D representations of option Greeks and all, and various other breakout systems and all. We have designed almost everything, every aspect of the market for equity investing, for breakout trading, and trading trending markets and all. So we have created so many scanners. Like this one is for Ichimoku. So it gives you basically Ichimoku, all trading setups from Ichimoku model, and how old the trade has been and so on. Then we've created scanners for intraday trading. Finally, let us come to our main theme. We wanted to present our Q3 results. So let's switch straight to our P&L. So this is our currency segment. Let me just reselect it. And let's take the date from 1st April to 31st December. It's already set here. Let me just make some changes so that it appears, doesn't appear, edited or something. Fine. So you can see 31st. Okay, so we have made around 42 lakhs. And this is our sample trades, not sample trades, sorry, real trades that we took. And so on. Finally, let us look into our quarterly performance. You go to reports, tax P&L. It's taking some time. Okay, we don't trade equity at all. So currency again 42 lakhs, but Q3 we should do it. Q3 it should be. We booked some loss on 1st January, so that is also reflected here. So let's just put it to Q3. Oh no, that's not good. Please no. Bingo. So 42.73 lakhs we made total gross profit, and the total charges for all this profit has been 75,000. Q3 was actually not good for us. We faced certain issues. We had started on a very bad foot. We had a bad trade to begin with the month of October, and that really put October month in loss. We were actually in loss in October month, but we covered it in November and December. Plus some events that we'll discuss that happened in December, which again reduced our profits a bit. So let's check how much we made in Q3. Should be around 12 lakhs something. Yeah, 11.53 lakhs. And as you see, this is this quarter the charges are quite high. Normally we maintain a ratio of 1:100. So for every 1 lakh rupees, the charges are normally 1,000. But this quarter we have around 20,000, 20,000 to 24,000 extra charges have come up just because of those loss-making trades. So we'll discuss them one by one. So that's it. That's our performance for this quarter. And I have a presentation on design thinking about how we take, what is the logic or what is the mindset with which we trade, and how should a newcomer trade the options market. So let's go with the slides that I have prepared for you guys. Okay, just put it in slide mode. Yeah. So the best strategy for options. Let me come back to this slide again. This says design thinking framework to options trading. What is trading? That's the first question. What is trading? Trading, what are we trading? Are we trading some assets? Yes, we are definitely trading assets. We are trading contracts, we are trading equities, we are trading on margin, we are trading on cash, and blah blah. Actually, we are trading risk. Specifically, when you are in the market, stock markets, you are trading risk. And against risk, you make some profit. And depending on how much risk, whether you are able to control it or not, you make losses. So trading is all about taking calculated risks to make some returns. The more the risk you take, the more potential you have to make money. But again, it's the other way around as well. You can really make some big losses in trading. So that is where things get complicated. Deciding how much risk to take and how to design your trades according to it. So let's go ahead with the presentation now. So the best strategy for options. No strategy is good or bad, but obviously you need to understand the preconditions, the entry exit criteria. So there is this girlfriend analogy. So any strategy is just like a girlfriend. Okay. Rather than strategy, it is approach to the strategy that is good or bad. How you approach the strategy, that matters a lot. Whether you will be whether you will be able to win that strategy, or you will stand losing that strategy. Just like a girl, if you want to woo her, there are certain rules. How you talk to her, how much you talk to her, and how you approach her. Similarly is the market. Then treat your strategy well and it will pay you back handsomely. So once you have made a girlfriend, then if you treat her well, definitely the rewards will be good. She'll stay with you, she'll not run away. And if you mistreat her, she'll definitely run away. Same thing goes with strategy. If you treat it well, and what do I mean by treat it well? Not all the strategies can be applied at all the times. You need to understand your girlfriend's mood. Similarly, you have to understand the market's mood before you can apply any strategy. There are preconditions, there are entry and exit criteria. What are the volatility levels? Where are the support and the resistance? Right? You design your strategies according to lot of parameters that market throws at you, and they are dynamic. They change every time. Every other day they are changing. The volatility level may be different today, and it may change tomorrow. So we need to consider all these factors. So obviously you need to have a good knowledge of options and Greeks and the risk associated with options trading. Gamma and Vega risk, for example. First thing first, master option pricing model and Greeks. So I assume even if you are beginner, I assume you have some knowledge of how options are priced, and what are Gamma, Vega, what are the option Greeks. If not, I will suggest you first of all go and learn about option pricing models and how Greeks are related to option pricing. Design thinking. First of all, know yourself, your experience level and risk appetite. Then decide between fully hedged versus unhedged based on the above. So if you are a newbie, if you are a newbie, there are so many freebies nowadays on internet, no, that just came out of my mind. Okay, so if you are a newbie, you should go with fully hedged strategies. Then select simple textbook strategies meeting your criteria and your kitty. So there are simple textbook strategies like uh, simple calls, buying puts, or buying a straddle, or selling a condor, right? These are all hedge strategies. So you should again first go and read about them. What are the different standard strategies? And then you can, this presentation will be more relevant for you. Next, understand opportunities, precondition and risks for each of them, entry, exit criteria. So again, I'll repeat myself. So based on your experience level and risk appetite, you decide whether you are going for fully hedged or unhedged. So if you're a newcomer, you will go with fully hedged. And in fully hedged, you will select all the, all the textbook strategies that are fully hedged. Okay. And then you try to analyze the market. What are the opportunities? What are the preconditions and risk for each of them? Entry, exit criteria, and so on. What is the volatility level? How are the premiums? Okay, where is the market trading? Is it at life high or life low? This COVID time has shown us everything. In March, we were at, so much low. I mean, multiple year lows, and now we are at life high. Okay, then the most important point is the next one. Just pick a single strategy and stick to it till you understand opportunities and risks associated with the chosen strategy under all conditions. Use Google search if required. Add lakhs to mitigate the identified risks. Research on opportunities. What does this mean? This means that, let's suppose you decided on condors. So condors have a certain precondition, like if you're selling condors, then your volatility should be high. So even when there are times when the volatility is low, then also you trade condors. You trade condors, and condors, and only condors. Even if it is volatility high or even if the conditions are not met. Why? Why? Because if you force something on yourself, then automatically you will start, finding answers to issues, or you will start improving. You will start finding issues and you will start finding solutions to those issues. This is how we learn. We just took condor and we just traded condors and condors and condors and adjusting them. Okay, volatility is high, pretty easy to manage. Volatility is low, what should we do? Should we increase the width of the condor, or should we bring them closer? Or should we, the sell side we should bring closer, and the protections we should move them far away? So there's a lot of options, and you will start exploring them and trying to understand, and you will be asking why. And once you have found out your why you should do a particular thing, you will know how to do that thing. And that's how you will learn. Okay. And once you do this, then you go with advanced adjustments, which will definitely change your strategy. Maybe because once you start asking issues, you see, my goodness, volatility is down, the premiums are so less, and for adjusting I have to move this leg and shift it down. No, but I'm not getting premium, so what should I do? Should I switch to next series for this leg or for this side? So obviously that will bring you to calendars, right? So this is how you start moving on to advanced level strategies or different strategies. So you'll be able to see the interrelation between different strategies. Why this strategy, why this strategies, and how they are interrelated. Okay. Now, again, the last line of this slide. Remember, no other choice, no confusion. So force yourself, just one strategy, stick to it, no confusion, just stick to it and keep fighting with it. So let's take a very simple case for USDINR. USDINR opportunities and characteristics. Let's look. What are the opportunities and characteristics? Low margin requirement. RBI interventions to control volatility. Skew, that is, call premiums are higher in USDINR. Threats, liquidity issues. We have liquidity issues, specifically in the faraway series. Difficult to predict direction. Yes, it's very difficult to predict direction in USDINR. Then news-based volatility. It's an international instrument. Okay, so any news in the US or Fed rate decisions or India RBI policy, these all affect where USDINR will go. Then of course the complication is that the effect may not be immediate. It may be after some time. How the macroeconomics play out to news-based, nothing is sure. It's not sure whether the impact will be right today. There's some major announcement, and the impact will be just tomorrow or maybe the day after. It could be even 1 week later. Okay. And third, constraints for us, like lack of time, part-time trading only. So we have volatility, skew, and directional risks, and the part-time constraint. So low margins and characteristics discussed above make us choose sell-side fully hedged trades as beginners. These trades will benefit from theta decay and require less screen time when properly hedged. Now decide a sell-side strategy from textbook based on volatility and skew considerations. We already have mitigated directional risks with hedge. Now start with easily adjustable strategy. A wide fly to begin with, for example. You cannot really adjust fly if you're a newcomer. So once you select an initial strategy, stick to it. Start understanding how the risks and characteristics are changing and transition to other strategies by way of adjustments. The new ones produced may not be textbook strategies, as we just discussed earlier. Don't shy away from booking loss-making legs or sides of trades to adjust. Many times, this is what happens. When we have a multi-leg option setup, the sides that are in profit, we are very good at booking at it and adjusting by making some new leg on that side. But we should also be very, alert and nimble and quick to remove loss-making sides if required for adjustment, of course. Also, you have to keep questioning situations, losses, and opportunities till you find answers on how to mitigate them. For every step, you need to answer why and how. At every step, you need to check all the preconditions, the volatility level, the strikes, where the current price is, whether it is a support or resistance. That will decide how you adjust, of course. Okay. Now, with so many contracts across strikes and expiries, the risks are best controlled by a Greeks. Master them. Each Greek maps to a risk or opportunity that you have identified. Now, how do you manage all these things? So many contracts, so many strikes, so many expiries, support, resistance. It's a lot of confusion. So option Greeks, they are just very 4 or 5 mathematical, rather statistical tools. They're Greeks. You just have to learn them, understand them, and start applying them. Again, this will come with practice. And they will cater to each and every risk or opportunity that you have identified. Now, don't be afraid to take the entire trade setup out if required. Stop loss based strategies work like a charm. Initially, you could simply start with this approach. This is also a very important point. How much should you be adjusting? You cannot adjusting, I don't recommend adjusting more than twice. Because sometimes instead of adjusting, it is better to take off the trade completely, all the legs, take them out completely, and initiate a new set of strategy based on the new conditions. Maybe the volatility level has fallen, or the stock is at some support now, or it has moved significantly. So the strategy might have changed completely. That will work now. So it's always better. And if you are a fresher or a newcomer, you can always do this. Always you can put up a standard textbook trade. If it goes in loss, have some patience, try to adjust it, otherwise simply book it off. Do this on paper trading first. Let's see an example trade setup in the next slide. So this is a typical USD/INR condor. Okay, so this is the center of this condor, and this is the price. This red line, this red vertical line denotes where the USD/INR is. Now we have started with an edge. Since volatility was favorable, but since we are beginner, we started our journey with condor. That is clear. What is the edge here? Since volatility increases as USD/INR rises, we have created a bit positive delta. What does positive delta means? Let us understand in basic terms. We have our condor is somewhat shifted to the right side, the body, main body. So the profit portion, the most profitable portion is here, this one, right? This is on the right side of the current price, because if the USD/INR moves in the forward direction, in the upward direction, So we will land up in the profitable zone. Okay, and volatility will also increase. That is a risk, because if volatility increases, then sell condor will be, it's not good for sell condor. So to offset that volatility increase, we have created more room for profit on the upside, so that if it moves up, we end up in a profitable zone, and that will offset any unfavorable volatility, the rise in volatility. Okay. Checklist for our USDINR condor at setup. Are preconditions, volatility levels, time to expiry, technicals, etc. met? Are there any economic events? Should we not simply consider call spread given high call premiums over puts? That is the skew. What strikes to consider for individual legs? Directional risks. Even if this is the best strike combination as of now, is it best or sufficiently good relative to past volatility, HV and I? So there are so many systems and so many tools available online which show you the best trade to take any particular point of time. Remember, if there are 4 strategies which you are thinking are competitive, the best one would be best relative to the other 4. But at a standalone level, does that strategy, is really good or the best relative to its own past? There are 2 types of comparisons you have to make. First, that strategy with respect to other strategies. Second, the selected strategy with respect to its own past. For example, based on volatility levels. Right? Okay. So, even if this is the best strike combination as of now, is it the best sufficiently good related to its past? Okay, we will discuss that. Now, given above pointers, is the risk reward worth? How do we determine favorable risk reward? What metric? This is our reward, this vertical height, and this is our risk on the downside. So what metric? How much vertical height we should be, keeping our payoff? How much downside we should be keeping? So what kind of condor should we be selecting? What are the strikes? Which strikes to sell? Which strikes to buy? So this talks about those things. Next, how much adjustments are we willing to carry? What is the maximum loss without adjustments? Can we reduce it by adjustments? Even though you see this much is the risk, let's suppose this is 10. By adjustments, it is very easy to reduce this maximum possible loss of 10 by 50% by adjustments. Okay, so this is how we basically increase our risk to reward ratio. Increase our reward to risk ratio. We try to optimize this whenever there is any bad situation, the market movement is there and we are not able to get the maximum profit, so we should try to minimize the loss. It's not about always profit. So even if we are not getting any profit, we should ensure that we don't get the maximum loss as well. Okay, we should try to reduce it as much as possible, and that is very much possible, up to 50%, 40% by even sometimes you can minimize by 70 to 80% by way of adjustments. Now, at significant move in one direction, should we book out the complete profitable side or do partial bookings? What if the price reverses back? How much is the time left for expiry? Yes, this is an important question. How much is the time left for expiry? Should we really be adjusting it, or is there high gamma risk or whatever? Are we getting significant premium on adjusting, or do we need to switch few legs to next series? Volatility levels, movement risks, skew, we need to consider them all. Can technical chart reading help us to resolve some of these issues? Can these trades be planned and executed leg by leg? Can we adjust to the point that some part is left unhedged? The last 2 points about legging in and legging out into any strategy, or trading unhedged, is once you gain some experience or maybe good experience. Okay, that's not advisable for newbies actually. So let's move. Option Greeks and discipline. Answer to most of these questions that arise during the trade setup and when adjustments are required is obtained with the help of option Greeks. As a beginner, master each Greek and its impact. Keep repeating this complete cycle over and over till you master one setup to begin with. Maintain trade logs and write down learning comments and ideas that you gain while trading. Read a lot and explore a lot, but choose wisely what you follow. But most importantly, learn to ask questions. Get obsessed with why and how. Optionstar. So let's talk about our tool Optionstar a bit. Based on the design thinking framework, we designed Optionstar to give us trades automatically. One best setup relative to others and to its own past. So Optionstar gives you just one trade setup. It's not like it will throw you up 2 or 3. At max, you can customize it to give you 5 best, but it will rank them. Okay, it's not like you can choose anyone based on your choice. It simply tells you this is number 1, this is number 2, and how much is number 1 better than the number 2. So this also tells that one also. So you will know their not only relative rank, but by how much one is better than the other. We trained Optionstar to consider all characteristics, risks, and opportunities, and throw us the best possible trade setup and the subsequent adjustment. So once you have set up, it will also help you with subsequent adjustments when things go wrong, obviously. It will also even tell you when you need to book out your profits. For example, if you go by the standard rules, 40% to 50%, maximum 60%, you should be booking out condors, right? But we don't follow these kind of standard thumb of rules. It's again totally based on Optionstar. It tells us when to exit. Sometimes even it tells us to exit at 90% of the profits. So based on all the market conditions that it analyzes. Presently, we are in the reverse mode. Optionstar is now training us to take trades directly without its help. It's a 360-degree framework. So we first designed Optionstar, and now Optionstar is training us. Sounds quite strange, but this is how it works. Because tools are tools. They, however knowledge we may have, we still need tools to analyze and look at the payoff diagrams, how they will look like, how will the Greeks vary, and so on. But now we have used it so frequently, and we have got into the habit of trading the best trades through Optionstar, that now we are able to do it directly. We have learned and we have understood the nitty-gritties. Excuse me. We have understood the nitty-gritties of the trades. Next, we are always in trades and our capital utilization is 90%. Also, we now don't use any technical chart. No suggestions from Optionstar. It's in our mind now. We don't even look at position payoff diagram, and we don't bother about any news or economic event. Minimalistic approach is the key for us. We designed our system in a manner that bypasses the need to use collateral money after pledging. Yeah, that's what I told you. We have capital utilization of almost 90%. So this is our USDINR trade returns month-wise. So the base capital, average capital is around 21 lakhs. Okay. And we started with 19 lakhs in March, and then we kept on adding little amount. So we are basing our calculations on 21 lakhs. So we have, our return is around 48% in December, 42% in November, but you see this massive minus 35% return in October. This is with respect to simple interest return. Okay, so the base capital is always 19 lakhs. So all these profits, this gross PL is being calculated on this 19 lakh. Okay, and this is for cumulative. That means on the capital, for example, this 4% is on the capital at July end. The total capital at the July end, the base capital plus all the money made through April to July. Similarly, this December is up to 19% on all the capital from April to November. All the capital plus the profits made from April to November. Okay. So, and the cumulative SI return is around 203%. So we have actually tripled our capital in 9 months, despite being, despite not having very good October month and some issues that happened in the last 10 days of December. So we'll discuss them one by one. So this is our breakdown of how we made money in calls and puts. So the skew factor, we talked about higher call premiums over puts, skew opportunity. So we exploited this skew and made 37 lakhs in call trades versus 5.7 lakhs in puts trade, while the corresponding quantities are not that different. This is because we utilized puts more for adding additional hedge to calls trades. That was our prime income. That required unique strategy adjustment. So as you can see here, the quantities and these are the returns. So mostly puts were used for hedging purpose. Now this is very, very important slide. Losses, important part of the game. If you ignore this last part, this is the recent trades, and this is what I was talking about. Before that, you see we have significant losses as well as significant profits. Any standard textbook strategy, if you hold it up to expiry, it will have minus 5% return in the long run. See, option trading is all about statistical trading. You have to trade the same trade over and over again, and then only the statistical probabilities realize out. So any source on the internet will tell you that standard textbook strategies will actually give you a small negative return over the long run if you hold them till expiry. So booking them right, having a stop loss system, maybe you can make 5%, and then with proper adjustments and earnings that you make through adjustments will give you returns as superior as maybe 100% per annum. 30% is pretty easy to obtain, I should say. So this slide should be an eye opener. It's not that we are just making 100% profitable trades. No, it's not like that. We do make losses and we make some big losses as well. But yes, they're very controlled. We don't make them in succession. We make them, after we have made some significant amount, we take some more risks. So it's all like control. We even choose to bypass Optionstar at times. If we have already met our quarterly targets, we take high risks. And then most of the time, actually we end up losing because we are not using any of our system. We are not even using our breakout systems. We just want to play, we're just gambling sort of. Yeah. And also, some of these losses are because of the trade setup itself. For when you are trading butterflies or condors, you will see these kinds of losses. Okay, you will, because there will be sharp movements. Dollar is volatile nowadays because of RBI sell-offs that we see and coronavirus and all. So this is an eye opener. This slide is actually an eye opener. It's not like we are making just profit. No, we are making losses on legs as well. Overall, we may be in profit, but we definitely book legs that have very, very high losses. So it's always covered. Like you see this portion. This portion is the one I was talking about. The last 10 days of December, what happened was Nifty crashed all of a sudden, and that was unexpected. And that resulted in dollar moving up by around 50 paisa. That would have been easily managed. But since this was not a very genuine crash, I should say, and the market immediately in the next few days revert back to life high. So from 13,300 it moved to 1400 plus. So that was painful, obviously, and this is what you see. So these are the losses. These were the losses because of the call shorts, and these were the put shorts that were for hedging. So if you look at the individual calls profit, so you see these are the call losses and these are the put profits. So these are the put profits, and this one is the a put hedge that again obviously went in loss because when the markets when dollar moved up, we booked profit in puts short. The puts long was in loss, right? And call shorts obviously were in loss, and some profit in call buy also we booked. Now, very important thing, you have to book losses as well. You have to book partial profits, partial losses. That is the ultimate goal. If you want returns like 200% or at least 100%, let us say, you will have to learn how to manage your quantities. Many times, let's suppose you are trading 10 butterflies, and if that butterflies goes into profit, you should book half or maybe one third. Maybe out of 10 butterflies, you should remove 3 butterflies or 4 butterflies. And then again, when the situation is favorable, volatility increases or price movement occurs in such a manner that you can again place butterflies at the new price point, around new price point. So this is how you will learn when you start trading in small quantities, and then starting with the basic textbook strategies, then moving into legging in and legging out and partial profit booking of the whole system, the profit side as well as the loss side, or maybe just the profit side or loss side, whatever strategy you choose. But stick to your strategy. Why? Because I'll give you an example. Let's suppose, let's not talk about option strategies here. Let's talk about simple trading system, some moving average based trading system, or based on VWAP or whatever. So you have one trading system. Unless until you stick to it, you will not be able to see its long-term return. And as I told you, trading is a statistical process. It's a long-term process. Okay. Stick to your stop loss. Now, your problem is the stop loss. बहुत ज़्यादा hit हो जाता है. It's like very huge. So what you should do? Again, there's a problem. The stop losses are big. So you need to put technical analysis into picture. You buy around support, sell around resistances. So you tweak your strategy, right? So that your stop loss is minimum. And now strictly trade with the stop loss. Keep on trading. And once you keep on trading over and over, you will start knowing why issues are coming up, why you are not making profit. You try to tweak them, you try to correct them, and you will learn. If you keep on flipping between the strategies, you will not learn, because you are just switching between strategies, and you are bypassing the basic premise of trading. That is, it's a statistical process. It's a statistical process. Returns are realized over a period of time. So don't think that today some strategy gave you 10%, the next year gave you 5%. No, you have to look at the complete time cycle of maybe 1 year or maybe 6 months at least. Okay, and back testing, yeah, well and good. Obviously, you should do back testing, but when it comes to real trading, there is a lot of psychology that goes into picture, and you will have to do that. You have to also choose trades that are less stressful. So that's my point. So you should stick to a strategy unless and until you are very comfortable with it. Before realizing it that, oh my god, it's totally useless and I should be dumping it. So at the first place, obviously design it well. Design it well, research it well, and then stick to it and carry it on for 1 year, and then optimize it. Improve upon it. So this is about our Giroda challenges. So we have won 10 times, and the 10th one we won with 13,000, around 13.5 lakhs. The 11th Giroda challenge, we are currently at 8.25 lakh profit, and we still have 16 days left, and I hope we are able to break our previous record for the Giroda challenge. That's it. Thank you so much, guys, and we will be uploading a lot of trading videos. That's in our plan. Trading videos means trade setups for the next day. We will also be putting stocks list which are on the verge of breakout, and we have some systems, like we have a system called Sparks. So Sparks is a system that gives you a list of all the stocks that will break out or break down. And believe me, we have seen this system give us a stock list well behind all the TV news channel guys. They give you at 12, 9 p.m., 9 a.m., 11 a.m., 12, 1 p.m. And we have that list one night before, or maybe early morning at around 7, or maybe at market open. So we have the same set of stocks that they recommend, but before them. By the time they give, we already have around 4 or 5 points, or maybe even 1% to 2% point advantage for them. Also, we will be trading options and we will also be putting option trading videos and tutorial sessions. Hope that they will be very useful to you guys, and you should promote this channel. You should, if you like this video, you should, and our performance, obviously, you should like and subscribe, so that definitely we need some motivation to put up more and more so that you guys can really benefit. We don't have any services. We did try training programs, but we were not successful despite good performance. And we took some free seminars and we got very good feedback. Hopefully we'll somewhere from April onwards. And just best of luck to all of us, including myself and our team. Thank you very much for watching this video.